There's a deep-seated yearning, isn't there? A quiet ache to peer beyond the veil, to glimpse the future of the market, to know with certainty where the next great opportunity lies. We've all felt it, that pull towards the seemingly magical predictions, the whispered tips, the gurus who claim to hold the keys to effortless wealth. It's a natural human desire, born from a hope for security, for freedom, for a life where financial worries don't cast a long shadow. Yet, how often does that reliance on intuition, on guesswork, or on advice that feels more like a lottery ticket leave us feeling adrift, frustrated, and sometimes deeply wounded by costly mistakes? The market, in its vast complexity, often feels like an untamed beast, governed by forces we can't quite grasp. We watch the charts flicker, listen to the endless stream of news and opinions, and feel that familiar sense of being overwhelmed. It's like trying to navigate a dense fog without a compass. We yearn for clarity, for a way to make sense of the noise, to move beyond the superficial narratives and connect with something more profound, more reliable. Benjamin Graham, the father of value investing, understood this yearning. He didn't preach crystal balls or market prophecies. Instead, he taught us that true investing wisdom lies not in predicting what the market will do, but in understanding what it is doing right now. It's about discerning value, about understanding probabilities, and about approaching the markets with a disciplined, analytical mind. Quantitative analysis, at its heart, offers precisely this lens. It's not about fortune telling, it's about rigorous, systematic observation and interpretation of data. Today, we're not here to offer you a secret handshake or a hidden conspiracy. We are here to demystify, to reveal three fundamental principles of quantitative analysis. These aren't arcane secrets meant only for the elite, but powerful insights that, when truly grasped and applied, can fundamentally change how you approach your trading. They can move you from a place of hopeful guessing to confident, data-driven decision-making. This is about building a more robust, more resilient approach to the markets, one that honors your ambition and your desire for sustainable financial mastery. We often find ourselves caught in the current of market sentiment, swayed by the latest headlines or the prevailing mood. We hear a company is doing well and instinctively want to buy, or a stock plummets, and the fear of missing out on a bargain whispers in our ear. This is the allure of the narrative, the story we tell ourselves about why a price is moving. But how much of that story is truly grounded in the market's underlying mechanics, and how much is just noise? Relying solely on these narratives, or on simplistic mantras like buy low, sell high without understanding the context, is like a doctor treating a symptom without diagnosing the illness. It's a path fraught with unnecessary risk. Quantitative analysis offers a different way. Think of it as a forensic tool for the markets. Instead of just observing the final price, it meticulously dissects the data that creates that price. It looks at volume, at volatility, at the speed and direction of price changes, and how different assets move in relation to each other. It's about breaking down the complex tapestry of market activity into its fundamental threads, allowing us to understand the how and, crucially, the why behind price movements. Consider a detective at a crime scene. They don't just see a body. They meticulously collect fingerprints, analyze DNA, interview witnesses, and piece together a coherent picture of what happened. Quantitative analysis does the same for trading. It helps us move beyond the surface-level observation of price changes to understand the underlying forces at play. Are we seeing a statistically significant trend emerge, or is this just a random fluctuation? Is there a predictable pattern of price reversion, or is this a genuine shift in momentum? This approach allows us to explore concepts like statistical arbitrage, where we identify temporary price discrepancies between related assets, or trend-following strategies that capture sustained directional moves. It's about finding those statistically significant patterns that stand apart from the inherent randomness of the market. And let's be clear, quantitative analysis isn't solely the domain of mathematicians with advanced degrees. The core principle is to equip you with the mindset to ask data-driven questions about your own trading decisions, to seek evidence before conviction. We are, by nature, storytellers. We see connections, we weave narratives, and in the world of trading, this can lead us down dangerous paths. We latch onto a compelling story about a company, or hear an anecdote about a successful trade, and we assume there's a direct causal link that we can exploit. This is the siren song of story stocks and anecdotal evidence. But often, these connections are superficial, or even illusory. We mistake coincidence for causation, and in doing so, we build our trading strategies on shaky ground. Quantitative analysis acts as a rigorous filter for these perceived relationships. It doesn't just accept a story, it demands data. Through statistical measures like correlation coefficients, we can quantify precisely how two assets or market factors move in relation to each other. Does stock A consistently move in the same direction as stock B? Do they move independently, or perhaps do they move in opposite directions? Understanding these relationships is crucial. The old adage, correlation does not equal causation, is vital but often misunderstood. While a high correlation doesn't automatically prove one causes the other. Quantifying that correlation is the essential first step. It's the detective's initial observation, seeing that two things are linked. From there, we can investigate further, or more importantly, use that quantified relationship to our advantage. It helps us understand which assets truly move independently, allowing us to build portfolios that are genuinely diversified, not just superficially so. Think about diversification. Many believe simply owning different types of assets is enough, but quantitative analysis can reveal a stark reality. During times of market stress, seemingly unrelated assets can all move in the same direction, amplifying losses. By understanding and quantifying these correlations, we can identify assets that offer true diversification, that provide a buffer when other parts of our portfolio are underperforming. It's about uncovering the hidden dependencies, or lack thereof, before they have a chance to inflict damage on your capital. This is how we move from hopeful diversification to data-driven risk management. The human heart is a powerful engine, but in trading, it can also be a source of profound error. Fear whispers us to cut our winners short, terrified they will vanish, while hope encourages us to cling to our losers, convinced they will inevitably rebound. This emotional tug-of-war is the enemy of sound risk management. We often operate on a gut feeling, a hopeful projection, or a fearful assumption, rather than on a clear-eyed understanding of the probabilities involved. Quantitative analysis offers a powerful antidote to this emotional drift. It provides us with instruments, much like a pilot uses to navigate the skies, that quantify risk. Instead of relying on how a trade feels, we can turn to metrics like value at risk, or VAR, which estimates the potential loss in a portfolio over a given period. We can examine the Sharpe ratio, which measures risk-adjusted returns, or the Sortino ratio, which focuses specifically on downside risk. These are not abstract academic concepts. They are data points that illuminate the true risk profile of our positions. Imagine a pilot flying through turbulent weather. They don't just hope for the best. They constantly monitor their airspeed, altitude, and engine performance through precise instruments. These instruments provide objective data, allowing them to make informed decisions and maintain control. Similarly, quantitative risk metrics provide us with the vital data needed to manage our trading positions with clarity and precision. This data-driven approach allows for a more actionable strategy. By backtesting potential trading strategies, we can gain a historical understanding of their risk-reward dynamics. We can then set objective stop-loss and take-profit levels, not based on a whim, but on statistical probabilities derived from past performance. This is where the true revolution lies, shifting from a reactive, emotionally charged approach to risk management towards a proactive, data-informed discipline. It transforms potential financial disasters into calculated, manageable outcomes, safeguarding your capital and paving the way for sustainable growth. We've explored how quantitative analysis helps us understand the why behind price movements, how it reveals the true relationships between different market elements, and how it allows us to master risk through objective data. Now, let's bring these three powerful insights together. This synthesis is where the true transformation occurs, moving trading from a realm of hopeful speculation to a disciplined, data-driven process. The secret weapon we've been discussing isn't some hidden, proprietary algorithm that guarantees riches. It's far more fundamental, far more accessible. It is the very mindset and methodology of quantitative analysis itself. It's the commitment to seeking evidence, to measuring probabilities, and to understanding the underlying mechanics of the market. This framework is your true edge. There's a common misconception that quantitative analysis is a mysterious black box, a system that spits out signals without clear logic. Nothing could be further from the truth. At its core, quantitative analysis is about transparency. It's about understanding the logic behind the data, the assumptions being made, and the statistical basis for any conclusion. The goal isn't to blindly follow signals, but to build your own robust decision-making framework, grounded in objective analysis. So, how do you begin to build this framework? It starts with defining your objective. What are you trying to achieve with your trading? Then, identify the relevant data that can help you understand the market dynamics related to that objective. Choose the appropriate quantitative metrics that measure price drivers, correlations, and risks. Crucially, backtest your strategies to understand their historical performance and, most importantly, iterate. The market is dynamic, and your framework must be too. Continuous learning and adaptation are paramount. The ultimate revolution this approach offers is profound confidence. When you trade with objective data, when you understand the probabilities at play, and when you manage risk systematically, you move beyond the emotional roller coaster. This disciplined, data-informed approach leads to more consistent, more sustainable trading results, and a deeper sense of mastery over your financial journey. It's so easy to get caught up in the immediate thrill of a winning trade, or the sting of a losing one. The market often presents us with opportunities for quick gains, and the temptation to chase chase those short-term profits can be immense. However, focusing solely on the outcome of individual trades without considering the long-term implications of our chosen strategies can lead us astray. It's like admiring the individual waves without seeing the vast ocean. Quantitative analysis, by its very nature, encourages a longer-term perspective. When we build our trading framework on data, on probabilities, and on robust risk management, we are laying the foundation for sustainable wealth building. These disciplined, data-backed decisions don't just yield a good trade today, they compound over time. This compounding effect, driven by consistent, intelligent choices, has the power to significantly outperform strategies that are swayed by fleeting emotions or the latest market fad. Consider the journey of an investor who consistently applies quantitative principles. They might not always capture the explosive, short-lived gains of a speculative frenzy, but their approach is designed for resilience. They are less likely to be derailed by market crash or emotional decision-making. Over the years, this disciplined compounding, this unwavering adherence to a data-driven process, often leads to superior long-term wealth accumulation compared to those who chase every headline or succumb to behavioral biases. The practice of quantitative analysis cultivates more than just trading skills, it fosters a set of invaluable habits. It demands discipline, the commitment to follow the process even when it's difficult. It requires patience, understanding that true wealth is built over time, not overnight. And it instills a deep commitment to the process itself, recognizing that consistent execution is key. These are the habits that are absolutely crucial for sustainable wealth accumulation, far beyond the outcome of any single trade. The true revolution, therefore, isn't just about revolutionizing individual trades. It's about revolutionizing your entire approach to investing and financial decision-making. It's about fostering genuine financial mastery, built not on hope or luck, but on the bedrock of consistent, intelligent, and data-driven choices. This is the path to lasting financial security and the realization of your ambitious goals. We've journeyed through the landscape of quantitative analysis, uncovering 3 core principles that can indeed revolutionize your trading. We've seen how dissecting price movements reveals the underlying drivers, moving us beyond the superficial market narratives. We've understood the power of quantifying relationships, discerning true correlations from mere coincidences, and building genuinely diversified portfolios. And we've grasped how mastering probabilistic risk management transforms trading from an emotional gamble into a disciplined pursuit. It's essential to remember, however, that quantitative analysis is not a shortcut to effortless riches. It is a rigorous methodology, a steadfast commitment to discipline, and a journey of continuous learning. It demands that we approach the markets with intellectual honesty, constantly questioning our assumptions and seeking objective truth in the data. As Warren Buffett wisely noted, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. Similarly, it is far more valuable to employ a sound, data-driven methodology at all times than to chase fleeting opportunities with a flawed strategy. The true power lies not in a hidden algorithm, but in the framework you build for yourself. This is your blueprint. So, I encourage you, begin to imbue your trading decisions with the spirit of quantitative analysis. Start questioning the narratives. Ask yourself, what does the data say about this price movement? What are the true relationships at play? What are the probabilities of this outcome? Explore the tools and concepts we've touched upon and begin to construct your own robust, data-driven framework. The revolution in your trades, and indeed in your entire approach to financial mastery, doesn't start with a secret formula whispered in the dark. It begins with the courage to embrace objective truth, to commit to data-driven logic, and to build a process that stands the test of time and scrutiny. This is the foundation of sustainable wealth, built not on ephemeral predictions, but on enduring principles.